Welcome everyone to Vested Interest. This is Shane, and on this video we are going to cover the two stocks I will be focused on buying in the month of November. Alphabet, many of you may know it as Google, right? And Lam Research, both of them out of the tech sector. Now, before we get into the video, I would like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, on this channel, we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks, and growing companies with positive cash flow that covers the dividend, and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing in the portfolio on a weekly basis. I also do larger purchases if I get a bonus or do a side job, something along those lines. I cover all my investments into the portfolio on this channel. I do not have a paid Patreon account. I'm not asking you to sign up for any other sites or go to any other websites. But if you would like to help out the channel, if you could do me a favor and hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that subscribe button down below. Click that notification bell so you're notified whenever we put out any new content. And drop a comment. Let me know what you are looking to buy in the month of November. There is a new feature on the channel. If you wanted to hit the thanks button down below and make a donation, that would be great as well. No pressure there. I completely understand we all have enough to pay for, so understand if you don't do that, but it is an option now on the channel. We've been able to monetize the channel with the amount of subscribers and the watch time we've had. So again, special thank you to all the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. Now, we're not going to focus on much this month here. Usually I think we do 3 or 4 in a month, but we're only going to focus on 2, and the first one is going to be Alphabet. I've been buying this one for a while now, ticker GOOGL. I'd like to get this to 100 shares before it really blows up. It's starting to creep up into the 170s. I'd love it to drop back into the 160s, where I've been buying it consistently for at least the last month. This was on last month's list as well. But as you can see here, $171.11. All these numbers are going to be from October 31st, end of business that day. And you're going to see this video on November 1st because that's the first trading day of a new month. And I want to get this one out to you. So let's take a look here at some of the metrics. Price to earnings ratio sitting at 22.69 per share. Forward PE lower than that at 19.91. I really like that the PE is under 20 for this one. Well, forward PE anyway is under 20. Obviously that will change if this continues to climb to the sky again. But it does pay a dividend, 80 cents per share yearly, 0.47% dividend. So it's a small dividend, and it just recently started paying a dividend as well. Now, 52-week range, it's as low, or has been as low as $126.93, as high as $191.75. It has a beta of 1.04, so it is just slightly more volatile than the overall market. The analysts call it a strong buy. Price target of $204.56, which represents a potential of 19.55% upside here. And as you can see throughout the day there, it definitely had a drop. It had jumped up into I think I bought it this week, maybe at 175. Hint, hint on what I bought this week. One of the things I bought this week. I think I bought it at 175 maybe. So it's been falling, though it was down in the 160s. So it really jumped up into the 180s and then has been dropping back down. But anyways, jumping over here, taking a look at dividend yield theory to see if this one is potentially undervalued. To do that, we look at the 5-year dividend yield average. We can't do that. So it doesn't have 5 years of dividends. It hasn't been paying it. We can't even really use the trailing annual dividend of 0.23% because they haven't been paying for a year. So all we really have to go on is they're paying, 0.46% dividend. Hopefully they're going to grow this over time. We don't know what that's going to look like because, again, they have not raised their dividend yet because they just started paying it. I don't mean to repeat myself. But the payout ratio is extremely low, 5.31%. So I am hopeful, or putting my money on this one, so to speak, literally, really, saying that they are going to raise the dividend. With such a low payout ratio and them deciding to pay a dividend, I foresee them raising it similar to what like Microsoft is doing, around 10, 20%, hopefully. And with such a low payout ratio, they should be able to do that. Their ex-dividend date was 9/9. They're back in September. They did pay out September 16th. Now, dropping down return on equity and return on invested capital, this really tells me how well the company reinvests back into itself. So I'd like to look at both these metrics, and I like 10% or better for both of these. Return on equity is sitting at 32.1%, smoking high. I really like that. Return on invested capital, same thing, 21.24%. EPS growth forecasted over the next 5 years is sitting at 19.95%, very nice overall, and revenue growth projected at 11.16%. Dropping down, looking at free cash flow, I like growing free cash flow over time because typically if a company has growing free cash flow, they have growing dividends to match. Going back here to December 2021, you can see 67 billion in free cash flow. Looks like a drop down in 2022 to 60 billion there, but we'll talk about repurchase of shares here in a minute. Back up in 2023 to 69 billion. And so far in the trailing 12 months, 55 billion. Obviously, we've got a couple months to go, and they did just release an earnings report. That part of the reason they popped up into the 180s was it was a very good earnings report. Now let's talk about repurchase of capital shares here. Again, going back to 2021 here, you can see 50 billion in repurchase shares. 2022, though it looks like a drop in free cash flow, it can be accounted for here in the increase in repurchase of capital stock. They went from 50 billion to 59 billion. Went up again. Not only did free cash flow grow in 2023, but they also increased that repurchase of shares again up to 61 billion. And it looks like trailing 12 months is going to be pretty close to the same as last year at 62 billion currently. And I don't know, I haven't looked at any reports to see if they are continuing to buy back shares or what their exact buyback plan is, but it looks like they're buying back every year. So I'm hopeful that this even gets up to 60, 65, 66 by the end of the year. They repurchase a few more, and we get into the 60s in free cash flow here. All right, and this last here on the bottom, this is my position. I'm long Google, right? So I already am in the position. I've been adding to this for at least the last month. I have 56 shares. My cost basis is $159.17, currently at 171. That gives me a 7.5% profit. Well, if I was to sell, I'd get a profit, but I'm in the green. To be honest with you, I would love this to drop back down into the 150s, 140s, even down to the 126 that it dropped here over the last year, and build out this position at really low. But I'll probably continue to add so long as my cost basis stays under 165. So I'd love it to drop back into the 160s there so I can build this out. Now the second of the two, again, only going to really focus on two this month. One, Google is a pretty expensive position. Two, I want to really focus on these and kind of build them out. Lam Research is the other one, ticker LRCX. This again is out of the information technology sector. Closed out the day here on Thursday, October 31st at $74.35. Looking down at the price to earnings ratio, 24.06. Another one that the current price to earnings ratio is higher than their forward at 20.34. I like that it's down in the low 20s there for a company like this in the tech space, in the chip space here. Dividend of 0.92. So again, another low dividend payer, kind of like Google, a little higher yield than Google, but only 92 cents per share on the year with a 1.24% dividend yield on it. So low yielding, but this one actually has been paying for a while. So they do have a nice 15%, or right around 15% raises that they've been paying out. So this one is fast growing, even though it has a low starting dividend yield. Ex-dividend date, September 17th. Looks like they paid out on October 1st. To those of you who owned them long enough before that to get the dividend, kudos to you. 52-week range as low as $61.82, as high as $113. So it is pretty close to their 52-week low, and I believe it is within 15% of their 52-week low currently, which is one of the areas I like to buy stocks within 15% of their 52-week low, setting a new 52-week low if we can. Now this one does have a high beta of 1.48, so I'm trying to use that to my advantage and buy it whenever it does pull back. Currently, it is lower than my cost basis, so that's good. Again, I don't mind a stock pulling back below my cost basis whenever I'm trying to build it out. Analysts call it a buy, and they have a price target of $95.79, which represents a potential of 28.84% upside. Another reason I don't mind adding to it right now. Earnings was on October 23rd, so if you wanted to check out their earnings, go ahead and check that out. Just happened here not too long ago. Now, jumping over this one, we do have enough data to look at dividend yield theory to see if it's potentially undervalued. To do that, we look at their 5-year dividend yield average of 1.15%. We compare it to their current 1.2%. And since the current dividend yield is over here, it's actually saying 1.24%. This is from stockanalysis.com. This is from Yahoo Finance. So they're a little off on their numbers, but we'll just call it 1.2%, still higher than their 5-year average. So it speaks to potential undervaluation, pretty close to fair value, slightly undervalued according to dividend yield theory. Another one with a very low payout ratio, 26.86%, not quite as low as Google, but still very low, giving them plenty of room to increase that dividend, and the dividend is more than safe. Now, again, I like to look at return on equity and return on invested capital to see how well a company is reinvesting back into itself. And their return on equity is sitting at 49.12%, well above the 10% I look for there, and return on invested capital at 21.5%, very close to what we saw with the Google on the previous slide there, and above the 10% I'm looking for there. Now, their EPS growth is just smoking high. EPS growth forecasted over the next 5 years, 110.29%. If they get even close to that, that will be very, very fast growing earnings per share growth. Revenue growth forecast is 11.91%. Very good revenue forecast as well. Jumping over, we're going to look at free cash flow again. Again, I like growing free cash flow. It's typically if a company has growing free cash flow, not only is, they're safe, they pay down their debt, they can reinvest back into the business, they can buy back shares, they can increase the dividend, which is what I'm looking for. So 2021 here, going back in time, you can see $3.2 billion in free cash flow. 2022 looks like a drop down to $2.5 billion, but we'll talk about repurchase of capital shares here in a minute. You're going to see something very similar to what we saw with Yahoo or with Google on the previous page. 2023 here, you can see $4.6 billion, so a big jump up. And so far, 2024 looks like 4.2. So maybe no, it's about right. Now let's look at repurchase of capital shares. So going from 2.6 billion in repurchased shares in 2021, big jump up in 2022 to 3.8 billion. So that what perceived drop in free cash flow, what looks like a drop in free cash flow from 2021, can be more than accounted for in the repurchase of capital stock, right? That's why you can't just look at one metric on its own. You have to look at all of these metrics together, and there is a deep dive that you need to do to be investing into individual stocks so you can understand what these numbers mean. If you were to just look at free cash flow, again, it might look like, 2022, you had a down year, back up in 2023, and then back down in 2024. So you could call this a cyclical company. But really, what you're seeing is growth, and they're just fluctuating their repurchase of shares based on what their growth is. 2023, again, they did decrease their share count, but they had a big increase in free cash flow. So repurchased 2 billion shares in 2023, down from 3.8 billion, but their free cash flow went from 2.5 billion to 4.6. And then 4.2 billion in free cash flow in 2024, but they've repurchased more shares in 2024 than they did in 2023. So what could be perceived initially as a drop in free cash flow is more than accounted for, again, in the increase in the repurchase of shares. Just wanted to point that out. So very similar to what Google does. They kind of fluctuate their repurchase of shares based on their profits. And LRX, again, another one I am long in, 102 shares currently. Now, my cost basis on this one is a little higher than where it currently sits, $80.05, down in the $74 range. So I am down 7% on this one. But again, I would love for this to be the case in Google as well. I'd love Google to drop below my cost basis so I can decrease my cost basis as I build out the position. And then in the future, it will give me greater returns. All right, here's a few others that I have on the list that I still think are very attractively valued. If you have any of these in your position, I may nibble on some of these throughout the week. I wouldn't mind adding to Haverty's. Pfizer's another high-paying dividend that's down right now. Kraft Heinz as well as pulled back. Nutrient Solutions, another one I'd like to continue to nibble on. Chevron's not even in my portfolio, but it looks attractive. CVS, I might add a little bit, but it's a large position of mine right now. General Mills, again, is not one in my portfolio, but it looks like it's attractively valued. And Genuine Parts Company had a recent pretty large drop, a little right around 20% drop there not too long ago, and it still remains pretty close to its 52-week low. That one looks attractive as well. Several others, the market has pulled back the last couple of days. I saw Microsoft drop by like 5 or 10% over the last couple of days. Several other large companies as well. Amazon had a little decrease there. So there is time to look in the market, or you should be looking in the market right now while things are starting to pull back. Put a plan together. What are you going to be adding? Let me know in the comment section down below. Love to hear from you. Well, that is really it for this one. As always, appreciate you stopping by. And if you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notifications bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. Hey, and welcome to November. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing in educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.